Imagine you are an institutional investor in Africa in 2025. Your country holds vast pools of domestic capital, bank deposits, pension reserves, insurance funds, national savings, and remittances. On paper, the financial system is liquid and growing, yet the paradox is unmistakable. Despite an estimated $4 trillion in domestic capital, most of it is tied up in low-yield sovereign securities rather than fueling productive investment. It's a structural pattern so widespread that the United Bank for Africa has called it a systematic misallocation of financial resources. But to understand how Africa reached a point where it has both abundant liquidity and chronic underinvestment, we need to step back and examine the architecture that shaped its financial landscape. Welcome to Spotlight in Africa, where we provide the clarity, data, and intelligence investors need to understand Africa's evolving markets. For decades, Africa's financial systems were designed around capital preservation, not capital deployment. Banks prioritized government borrowing over private sector lending. Regulators imposed strict investment mandates on pension and insurance funds. And even as economies liberalized, the continent remained heavily dependent on external funding for infrastructure and industrial development. Foreign direct investment continued to flow, $97 billion in 2024. Yet Africa still accounted for just 3% of global banking assets. The continent wasn't short on capital. It was short on mechanisms to channel that capital into real economic activity. This was the environment for years, stable on paper but stagnant in practice, until a shift in thinking began to emerge. Across financial institutions, policy circles, and fintech innovation hubs, one insight became increasingly clear: Africa's next phase of development must be financed internally. Analysts highlighted the imbalance. 85% of domestic financial assets were locked in short-term government securities. Very little was flowing into infrastructure, SMEs, manufacturing, renewable energy, or digital connectivity. This recognition marked a turning point. Africa wasn't facing a shortage of capital, it was facing a shortage of deployment. And from this realization, a new financial agenda began to take shape. Financial leaders started exploring modern mechanisms to unlock domestic resources, blended finance frameworks to de-risk large projects, digital banking and fintech platforms to expand access and efficiency, innovative credit models to support SMEs, regional investment vehicles to channel capital across borders. These tools signaled a shift toward an African-led model, one built not on external dependency, but on internal mobilization. With this shift, the continent's infrastructure priorities also evolved. The focus was no longer solely on export routes. It expanded to include systems that would integrate African economies and support the African Continental Free Trade Area, transnational rail and logistics corridors, digital infrastructure and data networks, green energy systems for sustainable growth, platforms for digital trade and financial interoperability. This vision recognized that Africa's competitiveness would depend on its ability to connect markets, industries, and people across borders and sectors. Yet unlocking domestic capital requires addressing long-standing structural barriers. Policy uncertainty and sector-specific regulatory fragmentation, underdeveloped local bond markets, limited long-term investment products, pension and insurance mandates focused on safety rather than growth, gaps in governance and project preparation capacity. Without reforms, capital will continue to default back into low-yield securities. But momentum was building, and Africa's financial landscape was approaching a critical inflection point. Today, Africa is positioned at a pivotal moment. It has unprecedented pools of domestic capital. Fintech adoption is among the fastest in the world. Regional integration is accelerating through AFCFTA. Development institutions are supporting blended finance at scale. and governments are increasingly aligned around the need to mobilize local resources. For the first time in modern history, the continent has both the capital and the tools to finance growth from within. This represents the strongest opportunity yet to reshape Africa's economic trajectory. Africa's financial future will be determined by its ability to unlock its own capital, transforming $4 trillion in domestic resources into long-term investment. This requires coordinated reforms, strengthening governance, diversifying investment vehicles, deepening capital markets, harmonizing regulations, and aligning institutional mandates with development priorities. If these steps are taken, Africa will not only reduce dependence on external financing, it will redefine its development model entirely. A model driven by internal resilience, powered by local innovation, and built on the simple but transformative idea that Africa can finance Africa.
For more intelligence on Africa's economy, finance, and capital markets, subscribe to our channel. Spotlight in Africa.